According to Business Insider, Palantir CEO Alex Karp has just put his finger on an issue that many stock investors are starting to worry about. Artificial intelligence might lift living standards broadly, but the really life-changing money could be concentrated in the hands of a small group of companies and executives. According to Business Insider News, Karp describes AI as creating a complete decoupling between the normal economic gains that most people see and the unimaginable wealth that a small group at the top can capture. For anyone investing in AI-related equities, that statement is not just social commentary. It is a strategic signal about where value might accrue in the market and how politics and regulation could respond. Business Insider mentions that Karp is not dismissing AI's economic value. He explicitly says AI will likely raise the standard of living for the average person. From an investor's perspective, that implies broad productivity gains, potential margin expansion for many sectors, and long-term support for equity valuations. However, he also stresses that the people directly involved in building and owning core AI capabilities may see their wealth multiply tenfold or more, while the average worker's gains are far smaller. In market terms, that describes a world where a narrow set of AI platform owners and infrastructure companies captures outsized returns, while downstream beneficiaries see incremental but not explosive gains. According to Business Insider News, Karp contrasts this AI cycle with past technology revolutions. Historically, the gap between the person at the bottom and the person at the top, though real, was more limited. Salaries might have doubled at the low end, and the top tier might have become a few times wealthier. Billionaires were rare. In today's AI race, he suggests that founders, early investors, and core infrastructure owners could become dozens of times richer. For equity investors, this maps onto the idea of extreme winner-take-most dynamics, a handful of AI model providers, cloud platforms, and specialized software players absorbing the bulk of economic surplus generated by AI. Business Insider reports that Karp calls this widening wealth gap the biggest problem in this country. That statement matters to investors because once something is defined as the biggest national problem, it invites political attention, regulatory experimentation, and potential redistribution mechanisms. Whether through tax policy, antitrust enforcement, data regulation, or constraints on AI deployment, this kind of rhetoric hints that the regulatory risk around leading AI names could rise over time, especially if their profitability and valuations appear detached from average wage growth. According to Business Insider, Karp also comments on the perception of AI-driven job losses. Even if AI does not cause catastrophic unemployment, people are afraid of it. One reason, he says, is that leading AI lab executives have repeatedly told the public that significant disruption is inevitable. Those executives, in his view, are now becoming very wealthy while telling ordinary people that their future will be painful. For stock investors, this creates a reputational risk profile around major AI labs and their backers. Companies associated with aggressive automation narratives could face political backlash, union opposition, and brand damage, which in turn can affect multiples, regulatory conditions, and the pace of adoption. Business Insider News notes that Karp did not name specific executives, but he implicitly referenced leaders such as Anthropic's Dario Amodei and OpenAI's Sam Altman, who have previously warned about job disruption before softening their public stance. For investors in firms tied closely to these labs or for holders of companies heavily dependent on their APIs and models, the lesson is straightforward: narrative management is now a material factor. If public discourse turns against big AI, high-visibility names might encounter policy headwinds similar to those experienced by big tech platforms over the past decade. According to Business Insider, Karp's remarks arrive at a time when anxieties around AI are spilling over into broader public backlash. Gen Z is showing resentment toward AI, and the data center boom is being met with hostility by communities and politicians concerned about energy use, water consumption, local infrastructure stress, and environmental impact. From an investment standpoint, this is important for anyone holding positions in hyperscale cloud providers, data center REITs, chipmakers, and infrastructure plays. Local resistance can slow project approvals, increase capital expenditure, and force utilities and governments to impose stricter constraints. Business Insider mentions that this is not Karp's first attack on the AI industry. Earlier this month, in a separate CNBC interview, he argued that something has gone wrong with the AI market. His Business Insider interview adds more color. He believes AI is being oversold as a simple, universal good that everyone will profit from. As he puts it, the overselling of AI in this country is disconcerting and unnecessary. For investors, this is a caution against unrealistically linear growth assumptions. If AI expectations are inflated, then some segments of the market are likely to face disappointment, earnings misses relative to hype, and valuation compression when the real adoption curve proves slower or more uneven than marketing narratives suggest. According to Business Insider News, Karp describes AI as a natural resource with both positive and negative potential. That framing is critical. Natural resources often generate enormous wealth but also trigger political battles, rent-seeking, regulation, and sometimes nationalization or heavy state control. If AI is treated as a strategic resource akin to oil, rare earth metals, or critical infrastructure, investors should expect a stronger hand from governments in setting rules, allocating subsidies, restricting exports, and possibly sharing in the economic rents. That can be positive for incumbents that align themselves effectively with national security agendas, and negative for firms that are perceived as extracting excessive profit or undermining social stability. Business Insider reports that Karp also has harsh words for some of the individuals leading the AI race. He describes them as unusually shaped IQ types whom ordinary people would not necessarily want at their dinner table, and who, in his view, cannot connect meaningfully with the broader public. While this sounds like personality critique, it has investment implications. Leadership style, public trust, and the perceived legitimacy of corporate stewards matter when regulators and voters decide how to treat an industry. Executives viewed as detached, arrogant, or indifferent can become focal points for political pushback, which can translate into stricter oversight or limitations on market power. Now, stepping back, let us look at what all this implies specifically for Palantir and for AI-exposed stocks more broadly. From a Palantir investor's perspective, Karp's comments serve several strategic purposes. First, they position him as a critic of AI hype rather than just another cheerleader. That can strengthen Palantir's brand with governments and enterprises that are wary of overpromises. Palantir already markets itself as a pragmatic, deployment-focused AI and data platform that works on real-world missions rather than speculative consumer use cases. By criticizing the overselling of AI, Karp is aligning Palantir with a narrative of realism, reliability, and long-term partnership. Second, Karp's focus on inequality and social risk may help Palantir manage regulatory and political exposure. By acknowledging the problem of extreme AI wealth concentration, he shows awareness of social externalities that many tech leaders avoid. For investors, this can reduce reputational risk. Policymakers may see Palantir less as a company blindly chasing profit and more as a firm that understands the broader system it operates in, especially given Palantir's deep integration with defense, intelligence, and public sector clients. Third, Karp's framing of AI as a natural resource dovetails with Palantir's core value proposition, helping institutions harness data and AI as a strategic asset while maintaining control, governance, and security. If governments and large enterprises increasingly treat AI and data as national-level assets, they will seek trusted partners for secure platforms, auditable decision pipelines, and compliant deployment frameworks. In that environment, Palantir stands to benefit relative to labs that primarily sell raw model access or consumer-facing AI products without strong governance layers. However, investors should also recognize the risks embedded in Karp's arguments. By highlighting AI-driven inequality, he implicitly underscores the possibility of higher taxation, more aggressive antitrust, or targeted regulation of AI profits. If policymakers take his warnings seriously, they could pursue policies that reduce long-term margins for the most profitable AI platforms, impose constraints on proprietary model deployment, or demand broader benefit-sharing mechanisms. While Palantir could navigate this through its government-centric positioning, the sector overall might face margin pressure. Looking at the broader AI ecosystem, Karp's comments reinforce a key theme for investors: concentration of value. AI infrastructure, training compute, data center capacity, leading foundation models, and critical software platforms are likely to harvest the majority of AI-driven profit. Downstream users and sectors will benefit but may not see the same explosive equity upside. This suggests a barbell strategy. On one end, investors may seek exposure to the narrow set of companies that truly own the stack: cloud hyperscalers, top GPU and accelerator vendors, critical networking component suppliers, and a small number of software platforms that become de facto operating systems for AI deployment. On the other end, investors might target specific industries where AI is clearly improving productivity and margins, such as defense technology, industrial automation, certain areas of healthcare analytics, and enterprise software that tightly integrates AI into workflows. According to Business Insider News, there is also clear evidence of rising public resistance. Gen Z skepticism toward AI can affect adoption of consumer AI apps, social features, and automation tools in fields like creative work and content platforms. Local backlash to data centers can slow capacity build-out, which might constrain the near-term growth of AI workloads or at least raise the cost of scaling. For investors heavily exposed to AI infrastructure growth narratives, this means they must monitor permitting processes, local political debates, and the evolution of environmental regulations, not just demand forecasts from cloud customers. Another angle highlighted indirectly by Karp's remarks is the role of storytelling in valuation. AI leaders have benefited from powerful narratives. Everything will be transformed, jobs will disappear, productivity will explode, and their platforms will be indispensable. This has supported high multiples and significant capital inflows. Karp, by calling this oversold, is reminding investors that narrative risk is real. If AI adoption is slower in certain sectors due to compliance issues, integration complexity, or human resistance, some of the most optimistic revenue models will be revised down. Holding positions that are fully priced for perfection becomes dangerous in such an environment. For Palantir specifically, investors should consider how this macro context intersects with the company's core markets. Palantir operates heavily in defense, intelligence, and government analytics, as well as regulated industries like healthcare and finance. Those sectors are less likely to adopt AI on the basis of hype and more likely to demand explainable, governable, and controllable systems. Karp's narrative of AI as a powerful but double-edged natural resource aligns with the cautious attitudes of these buyers. If that alignment deepens trust, Palantir may see continued expansion in large multi-year contracts, AI-enabled platforms for defense and security, and mission-critical decision support tools. At the same time, the inequality debate could influence budgets and priorities in Palantir's key markets. Governments facing public concern about AI concentration might direct spending towards systems that emphasize accountability, transparency, and societal resilience, rather than purely commercial or consumer AI applications. Palantir's positioning as a partner in national security, critical infrastructure, and public sector governance places it in a potentially advantageous spot to capture a share of that reoriented spending. For private sector investors and enthusiasts tracking AI stocks, Karp's comments offer a checklist of forces to monitor. First, monitor inequality and political rhetoric. As AI-related profits and compensation concentrate at the top, calls for redistribution or constraint will grow louder. This affects the regulatory outlook for leading AI companies, especially those with visibly high margins, massive pay packages, or perceived social harm. Second, track public sentiment and generational attitudes toward AI. If Gen Z and younger workers treat AI with suspicion or outright hostility, adoption could slow in certain fields, labor relations could become more contentious, and companies might need to invest more in change management and worker upskilling. That can stretch timelines for realizing cost savings and margin expansion from AI automation. Third, watch the data center and infrastructure build-out. Resistance from local communities, environmental groups, and regional governments can delay or reroute investment. Companies with strong relationships to regulators and credible decarbonization and efficiency plans may be better positioned to secure approvals and maintain growth. Fourth, pay attention to narrative and valuation discipline. When a CEO of a major AI-exposed company publicly warns that AI is being oversold, it is a signal to be careful about paying peak multiples based on optimistic promises alone. Look for evidence of real deployment, enterprise contracts, renewal rates, workflow integration, and measurable productivity improvements, rather than just demo-driven enthusiasm. Finally, consider governance and alignment. Karp's critique of AI lab leaders as eccentric and detached underscores the importance of leadership that can communicate with both elite technical communities and ordinary citizens. Firms whose executives can build trust across those groups may face fewer political and regulatory obstacles, which is especially relevant in sensitive areas like defense, national infrastructure, and public sector AI adoption. According to Business Insider, Karp ultimately believes AI will make many lives better, but he rejects the idea that it will be a universal, unproblematic boon that enriches everyone equally. For investors, that dual view is actually useful. It encourages optimism about long-term productivity and value creation, while maintaining skepticism about distribution, political stability, and valuation excess. As you think about Palantir and broader AI-exposed equities, Karp's message can be boiled down into a few practical investing mindsets. Expect AI to remain a powerful growth driver for select companies and infrastructure providers. Expect the distribution of gains to be highly skewed. Expect social and political friction to rise as those gains become more visible. And expect that companies which anticipate and manage this friction responsibly may enjoy more durable, less volatile growth than those that lean purely into hype. For holders of Palantir shares, Karp's interview reinforces the company's identity as both an AI beneficiary and an AI skeptic. It is a firm that wants to be seen not just as a builder of tools, but as a partner helping governments and enterprises navigate the risks and trade-offs of AI deployment. Whether that positioning justifies Palantir's valuation at any given moment is a separate question that depends on growth, margins, contract wins, and execution. But strategically, this kind of public stance can help Palantir remain relevant and trusted as AI becomes entangled with national policy, defense strategy, and debates about inequality. For investors across the AI landscape, the underlying takeaway is that AI is not just a technology story or a revenue story, it is a political economy story. Equity prices will not be driven solely by model performance metrics or headline revenue growth, but also by how societies choose to shape and constrain the distribution of AI-generated wealth. Alex Karp's comments are an early, explicit recognition of that reality. Keeping that broader frame in mind may help investors navigate both the opportunities and the inevitable volatility that will come with the AI age. Thank you for listening to this episode. If you found this analysis helpful, consider subscribing and sharing the podcast so you do not miss future discussions on AI, markets, and investing.